Hi, thanks for checking out the 360 property blog. I wanted to address the question, is property investing better than investing in shares? So let's try and unpack the two different asset classes and see which potentially is easier and better gains. So if you've done the Dream Life coaching course, or you're just looking at trying to replace your current income, you've got some spare cash, and you want to invest, you want to build up to replace your pension or just provide another income stream and get out the job you don't like. It's often can be confusing as where to put your money. There's all these schemes. Two of the big areas that people talk about is investing in property, buy to let, or in shares. Now, if you look at shares, for example, say you had £25,000 at the moment. You want to invest that to try and get a maximum return. So with shares, when you buy a share, if you buy an individual shares, you pay for that full amount. So if I was going to invest in Amazon right now, it's about $3,200. I have to put down $3,200 for every share. 25 grand going to roughly get me about 8 shares at the moment. Likely Amazon's got a monopoly, it's going to grow pretty well, it's not bad. Or you can invest in it, but you will pay a price for that, and then until you actually sell that share, you don't materially get any money back. Not with Amazon. There's no dividends, so you'd have to buy a share with a dividends at typically like 1% or less normally, and you'll get a few percentage back for every share you've got. Shares are also quite volatile, up and down, swings of the market. A lot of that is algorithmically driven nowadays. So you can invest in funds. Warren Buffett says if you're going to invest in shares, the average man without any inside knowledge, key information on companies and the limited time they've got, buy an index tracker fund, and they're typically less than a percentage. Or you can buy managed funds, and there's all these funds that claim they can give you 10 and 15 whatever percentage back. A couple of things to unpack there. Typically the percentage returns on share funds will be averaged over a year. That's not what you see in almost all cases. So throughout that year, if a share took a 10% dip, he actually needs to rise 11.1% just for you to get back to the status quo you were at before the dip. And this is where the averaged returns over a year are quite misleading, because it doesn't account for, you don't see those dips, and you can often only end up a small percentage, and then you've got the charge coming off anyway. Equally with shares, with it being quite volatile, a lot of people underestimate their ability to handle risk and what they're comfortable with. Statistically, it's shown that most people buy the shares at a high price when everyone's buying them because they get excited, and then they sell when there's a significant drop and solidify those losses. So they tend to wipe out all of their losses. There's some of the issues with shares. So just to recap, you pay your full price, you've got a percentage management or holding maintenance fee on it. Unless you get dividends, you don't get any return until you sell them. I think the other one, cashing in, buying too high and cashing out too low are quite common, although that can happen with every asset class. Property, on the other hand, to give it a flip side, if you have that same 25,000, typical with property is you leverage your money through a mortgage. So that 25,000 on a buy-to-let, 75% buy-to-let mortgage would allow me to buy £100,000 property. So straight away, my 25,000 becomes 100. The price increase on the property you are getting on the whole 100,000 as opposed to your 25,000 that you've invested. So you're leveraging your money. That works the flip side. If it goes down, you've potentially lost more. But yeah, that's a key part with property. Typically, again, with property, most of the investment that people go for, whether it's commercial or residential, is for a rental income. So it's paying you money as long as you've got a tenant in there holding the the agreement that you've set up, you are getting money on a monthly basis that is calculated to be higher than your operating costs and have a profit margin. And that profit margin, when stacked up, is what makes property quite an attractive asset class. Because if you make £1,000 per property type, say it's a HMO or something, and you're making £1,000 a month profit on that, you calculate that you need £5,000 a month to live your life and not go out and do a 9 to 5, then all you need is 5 of those assets that are producing £1,000 income, and you've got your monthly income covered. Another key part with property, linked in with the whole leverage aspect, is inflation. If you've borrowed £75,000 and the inflation actually means that £75,000 this year is less next year. Now, typically governments like to keep stuff around 2% inflation, in part because that makes the whopping money that they borrow worth less next year. And so for you investing, it also makes your borrowings worth less. So £75,000 this year is actually probably about £73,500 in real money terms next year. And when you've got a 20-year mortgage, it can kind of about half or more the actual value in real terms of what that money is without even paying it down. So when you pay it down and the property goes up at the same time, you are getting this double benefit of percentage increase on the whole value when you've only put a fraction of that amount in, and then inflation decreasing the amount that you owe against the gain. So it's a kind of a bit of a win-win. Those are the other thing that why I see property is a really good investment class is if you do your metrics at the start and you look at the what type it is, it's a lot easier to pick the right type of property, and then essentially you can have estate agents running it, people let it. It's recurrent income without you needing to do a 9 to 5 job on it. So it allows you to continue earning another income or running some other business while building up this secondary income stream. A lot of shares, I tend to think, need a lot more ongoing review of how that company is. And also with property, when you buy that property, you own that asset, you control it, you can manage, you can do whatever you choose with it within reasons of planning and building regs. When you buy shares, you're essentially only indirectly holding a part of that company, and you're beholden to how that company is run, what other issues they get involved in, or management changes. They're all outside of your sphere of influence, whereas with a property, much more direct control, much more able to react to situations for your benefit. So that's looking at the pros and cons of the different asset classes personally, and not just because they're talking on a prop blog. I think property is certainly for someone starting out, not a millionaire. Property is much more, it's got a higher entry level. You typically now need your in tens of thousands, 20,000 plus realistically. Yes, that entry threshold is higher than I can go and buy Amazon share $3,200, or some of the other stuff. I think Boho at the moment running around like sort of £3 or something like that. That's a lot easier to get into, but consequently it gets a lot more noise. Property, a little harder to get into, but a lot more realizable. You're leveraging your money, you're making it work a lot harder, a lot easier to get a monthly income, a lot more reliable and stable, and you benefit from all the inflationary games. So hope that was useful. Continue to check us out, and best of luck on your journey.